Today, more banks behaving badly. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, the ANZ has been slapped with a lawsuit for allegedly misleading 500,000 customers in a $200 million failure. ASIC has commenced civil penalty proceedings in the federal court against Australia and New Zealand Banking Group for failing to provide certain benefits that it agreed to give customers with offset transaction accounts. According to the corporate regulator, between mid-1990s and September 2021, ANZ failed to provide fee waivers and interest rate discounts to 580,447 customer accounts, which resulted in the Big Four having to remediate nearly $200 million to impacted customers. Commenting on the charges, Deputy Chair Sarah Court said in a statement on Thursday that ANZ's conduct was long-standing and impacted over 500,000 customers. These customers are entitled to receive the benefits they signed up for and in many instances paid for. This case is yet another example of a widespread system failure by a major bank impacting thousands of customers, as Court noted. This matter marked the final investigation by ASIC arising from matters considered by the Royal Commission, a constant theme of which has been the failure of large financial services entities to honour customer agreements. ASIC will continue to take enforcement action in relation to misconduct of this nature, as Court confirmed. ANZ's break-free package, introduced in 2003, offered fee waivers, interest rate discounts on eligible ANZ products such as home loans, credit cards and transaction accounts, and other benefits in exchange for paying an annual fee. ASIC alleges that those entitlements were not always provided to customers. And moreover, according to the corporate regulator, ANZ's offset customers were entitled to interest rate reductions on eligible home and commercial loans, which were not always provided. ANZ has admitted to making false or misleading representation, noting also that its bank systems and processes were not capable of delivering those benefits consistently, and that it breached its obligations as a financial services and credit licensee to provide services honestly, efficiently and fairly. ASIC is now seeking declarations, pecuniary penalties and other orders against ANZ. ASIC and ANZ will submit to the court that a penalty of $25 million is appropriate. So once again, another bank behaving badly, but also the penalty seems to me to be pretty weak based on the size and shape of the issues in hand. Be interesting to see what the court thinks. And talking of behaving badly, the share of new lending with high debt-to-income ratios rose again in the September quarter, according to the latest data from APRA. They released the quarterly authorised deposit-taking institution performance and the quarterly property exposures publications for the quarter ended September 2021. Over the 3 months to September, banks funded $167.8 billion in new loans. That's the largest amount in recent history and a 48.2% increase on the 2020 figures. The third-party channel, meaning mortgage brokers, wrote 58% of all ADI loans in the quarter, which is worth about $97.3 billion. This marked a 3 percentage point increase on the same quarter the year prior and is the highest proportion recorded for this data series. Both owner-occupied and investor lending grew to new highs over the quarter, with just over $115 billion of owner-occupied loans funded at 69% of the total, and $48.9 billion in investor loans, which is 29.3% of the total, in the 3 months to September. Notably, the quarterly figures also showed that higher debt-to-income ratio lending has occurred in the quarter, influenced by the low interest rate environment, increasing house prices, and relatively low wage growth. Nearly a quarter of all new residential mortgages, actually 23.8%, funded over the 3 months to September 21, had a debt-to-income ratio over 6 times. That's markedly up from the 16.3% in the September 2020 period and the 21.5% in the 3 months to June 2021. Given the high DTI proportion has been rising in recent years, APRA announced earlier this year a 50 basis point increase in the minimum interest rate buffer used in ADI serviceability assessments, which took effect from 1 November 2021. And it's expected that the new serviceability buffers will help reduce the proportion of high DTI lending from the next quarterly instalment. But the regulator has previously revealed that it may vary the minimum level of the buffer up to 5% if necessary. And according to the property exposures data, the banking industry resilience remains strong in the September 2021 quarter despite lockdowns across New South Wales and Victoria, with banks seeing a 73% increase in profitability than the same period in 2020. The data showed that ADI net profit after tax to the year ended September 21 was $36.4 billion, up from $21 billion a year prior. APRA suggested this was partly due to banks releasing provisions raised during the earlier stages of the pandemic, the fact that ADIs held strong capital and liquidity positions, and non-performing loans remained broadly stable. And that's the point, really, that those profits did rise, but they were predominantly driven by higher loan volumes and also the release of provisions. Underlying margins were certainly under pressure, and going ahead, the chances are net interest margins will continue to be pressurised. And that begs the question then, are banks behaving badly? Are they still making loans they shouldn't be making? Well, on my analysis and data, the answer is yes. They are yet to really rein in bad lending. And unfortunately, some of this is going to come home to roost down the track, particularly if interest rates rise. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.